Question 51. 1 year ago, ABC Corp bought a corporate bond for $1,000 and classified it as available for sale. It collected $40 in coupons, and the bond is now worth $1,020. What should ABC Corp show for this bond on its balance sheet? $1,000, $1,020, or $1,060? So from the reading, we would see that securities available for sale classification are going to be held at fair value. So we're going to put what the bond is worth now, and that's going to be this 1,020 number. So we're going to go with B 1,020. Securities held to maturity would consider the coupon and are held to amortized costs. This would get us to a different answer. But none of these answers would make sense for that, since the coupon is going to be subtracted in that calculation. So since we're doing held to maturity classification, we're going to have that be and hold it at fair value. Question 52. Which of the following may be considered a warning sign indicating the manipulation of financial statements? And our answers are going to be some combination of these three. So either answer number 3 is going to be manipulative, 1 and 2 are going to be manipulative, or 1, 2, and 3 are all going to be signs of financial statement manipulation. So we'll just start with 1 and go down the line. Excessive non-recurring costs classified in the income statement. This could definitely be a sign of manipulation. Generally, indirect costs or non-recurring costs are going to go in the indirect cost section, not on the income statement, kind of above the line, so to speak. So 1, yes, could be considered a warning sign. 2, net profit of 2% in the first 3 quarters, followed by a net profit of 17% in the fourth quarter. Something this inconsistent could indicate some type of cherry picking or moving around of expenses to different quarters to kind of make profit growth look better for some other reason. So this is also going to be a sign of potential manipulation. So then lastly, number 3, the number of days of sales outstanding was 15 days. The same figure for the industry is 75 days. So I think right away that's going to be a pretty big red flag, just with that big of a difference from the industry. The company is engaged in providing engineering consultancy services, and customers generally pay after the design is submitted by the company, has been approved by the customer's construction team, which takes roughly 2 to 3 months. So with this big of a lag time, and they're doing sales outstanding of 15 days, that's a pretty aggressive revenue recognition policy, since generally you're supposed to be recognizing that revenue as services are provided. So the industry figure really aligns with that, 75 days, 2 to 3 months, whereas theirs is, half a month. So we're going to say that's also a red flag. And so that is going to lead us to choose C, 1, 2, and 3. Question 53. An analyst needs to study the U.S. bond market. The entire population of 10,000 bonds is divided into small samples based on their maturity period. This is most likely an example of A, systematic sampling. Systematic sampling would entail taking from that entire population of 10,000 bonds and then determining the sample based on some predetermined rules or periodic interval to pick what's in the sample. So it might be like every 5th bond, as a simple example like that. So since we're dividing them more so based on a criteria and not a systematic interval, we can cross off A. B, simple random sampling. This is also going to be randomly selecting from that entire population, and is going to be selecting a certain number of bonds based on a random methodology, and that random methodology should entail all of those bonds having an equal chance of getting into the sample. But I think, again, that key here is dividing based on some criteria as the maturity period, which is not what would be used in the process of simple random sampling. So we're going to go with C, stratified random sampling, which does entail dividing the population based on some characteristics. So in this case, it's going to be based on the maturity period. So answer C. Question 54. LiveCom, a pharmaceutical company, is working on a drug that would cure leukemia. The total costs before the stage of assessing feasibility were $23 million. The molecule has passed the feasibility stage, and the company intends to develop the molecule for commercial sale. The development was completed within 6 months, and the costs incurred amounted to $76 million. However, the company has not yet received any approval from the FDA. The most appropriate accounting treatment of the costs if the company follows IFRS is A, record an expense of $23 million and intangible asset of $76 million. B, charge an expense of $99 million and record an intangible asset of $23 million after receiving approval. Or lastly, C, record an intangible asset of $99 million, charge an expense of $23 million if the approval is received, and $99 million if the FDA rejects the molecule. So the key things under IFRS are going to be that this feasibility portion. So under IFRS, anything related to assessing the feasibility or getting to is going to be considered exploratory and really just gathering information. At this point in the process, there's a pretty good line drawn where you don't know if there's going to be a commercial product viable or any chance to make money. So it's all exploratory, and because of that, this $23 million is going to be expensed. So then the second key part is that you can make something an intangible asset once that technical feasibility is obtained and there is intent to use the molecule for or develop the molecule for commercial use. And so in this instance, they are meeting that criteria. We can see it passed the feasibility stage, and the company is planning on developing it for commercial sale. There's no rule about FDA approval being a requirement. However, that would probably be helpful for making the case, but it's not a requirement. So looking back at these answers, we're going to go with answer A, record an expense of $23 million to kind of correspond with that pre-feasibility or the feasibility assessment. And then because we're past the feasibility stage and we meet that criteria, we can then make that $76 million an intangible asset. Answer A. Question 55. In the United States, listed companies are most likely to provide the following details in management discussion analysis. We've got 4 statements here and our answers, which are different combinations of them. So we've got 1 and 2, 1, 2, and 4, or 1, 2, 3, and 4. Just kind of as a question answering, if you're looking at this on the exam. 1 and 2 are in every single answer, so we really don't even need to look at those. We really just need to focus in on 3 and 4. We'll still take a look at 1 and 2 just for explanation purposes. But when you're going through the exam and you see that, you can just kind of breeze past that and make sure you're focusing your time properly. Okay. So 1, significant events and uncertainties that affect the company's liquidity, capital resources, and results of operations. This is certainly going to be something important for management to provide some additional context on. It's not something that can necessarily just be derived from the financial statements and numbers. There's definitely a qualitative component there that would be helpful for management to provide further context on. 2, information about the effects of inflation, changing prices, or other material events and uncertainties that may cause future operating results and financial condition to depart from the current reported financial information. Kind of same thing as 1. I mean, this is going to be some good qualitative information where management can certainly provide additional context to, just what the numbers are showing. And it's also a little bit more forward-looking since it's talking about future, so management can kind of give their opinion on what they think could happen going forward. 3, information about off-balance sheet obligations and contractual commitments. These 2 things are certainly things that management will be helpful for to really just help understand why something is being classified a certain way, and meaning the off-balance sheet obligation, why is it being held off-balance sheet, and to what benefit is that to the company and shareholders, and then any other context around contractual commitments is also going to be helpful for analysts kind of looking at baking stuff like that into their numbers. 4, critical accounting policies that require management to make subjective judgments. Anything that's subjective is going to require some additional information from the people making those judgments. So 4 will also be something that's provided in the MD&A, so we end up getting answer C, 1, 2, 3, and 4. All 4 statements are likely to be provided. Question 56. During a seminar, the speaker asked the attendees to give their understanding of high-quality financial reporting. The attendees gave the following key points. So we've got our 3 statements here, and then which of the statements mentioned above is the most accurate justification of high-quality financial reporting? So 1, 2, or 3. So we're just determining which of these 3 statements is most accurate justification of high quality financial reporting. So let's go through these. 1, high quality financial reports must have consistent profit. We may not always turn a profit, and for high quality financial reports, we want accuracy, not manipulation that's going to just show a profit. So that's going to be wrong. We'll cancel out A here then. Statement 2, high quality financial reports spend a good amount of time and energy on the presentation and distribution of financial reports. Time and energy doesn't necessarily make reports good or useful, so we're going to go ahead and probably cancel that out too, but let's just make sure C sounds correct. High quality financial reports are decision useful. This is what we're looking for. We want our reports to be useful and helpful for analysts, creditors, other stakeholders to be able to better understand the business dynamics and able to use that information to make decisions. So we'll go with answer C. Question 57. When an auditor determines that financial statements depart from accounting standards and are not fairly presented, he or she issues A, qualified audit opinion, B, an adverse audit opinion, or C, an unqualified audit opinion. This question is really just going to be a function of kind of remembering or memorizing what these different terms mean in the context of audit. So qualified audit opinion is going to mean that there's some scope limitation, but the key word we're looking for here is that the financial statements depart from accounting standards. So a qualified audit opinion tells us that there's a scope limitation in their opinion, but it's not indicating that the financial statements are not presented fairly. So that's not going to be our answer. We'll cross out qualified. Adverse audit opinion. This is probably going to be our answer because this indicates pretty much exactly what the question asks and tells us that the financial statements are departing from accounting standards. So that's probably going to be our answer. But let's just take a look at C first. Unqualified. this is going to mean that the financial statements are, they're giving a reasonable opinion that they're fairly presented in accordance with the standards. So that we'll be able to cross out C there, and we'll go with answer B. Question 58. The financial data of unilateral equipments for the year 2014 is provided in the following table. Got all our financial data right here that we're going to need for the question. Assuming a tax rate of 40% for the firm, the free cash flow to equity for the year 2014 is closest to. So first thing we'll do is just pull in that free cash flow to equity formula. We've got cash flow from operations minus fixed capital investment plus net borrowing. And so let's just go through each of these different variables, which is going to kind of lead us down the road to our first answer. So I'm going to go easiest to hardest, I guess, for deriving these different numbers. So the fixed capital investment, that's going to be pretty easy because they'd give us right here increasing capital expenditure, so 180. So we're just going to plug that 180 in right there for capital investment. Net borrowing is going to be pretty simple as well. So we've got our debt issued, and we're just going to subtract our debt repaid. So that's going to be 330, or 450 minus 330 give us 120. That'll be our net borrowing number. So from here, we'll move on to the cash flow from operations number. This is going to be a little more difficult because they're not giving us the exact number, but we can derive that from net income and all these different numbers they give us. So cash flow from operations, it's going to be our net income, add back our depreciation of 57, and then we're going to, these are all going to correspond down here. So net income is 700, depreciation 57, and then we're going to add back the decrease in accounts receivable. And then we're going to subtract out the increase in inventory of that 36. That brings us to 770. So bringing that all together then, we're going to take that 770 number and we'll subtract that fixed capital investment of 180, add back the 120 for the debt issued minus debt repaid, and that brings us to 710. So we kind of throw in the tax rate here at the end at this question, and that's a little bit of a smokescreen here. Free cash flow to the firm would use that tax rate as a part of adjusting for the interest expense. But since we're doing the free cash flow to equity, that's just kind of in there to throw us off, and we don't actually use it. So we get answer B. Question 59. Under U.S. GAAP, which of the following leases will be recorded as a finance lease from the lessee's perspective? A firm leased equipment with the asset's present value of $81,575, while the asset's fair value is $97,000. B, a jet rental company leased a private jet from a leasing company for 10 years. The economic life of similar jets is 12 years. Or C, a firm leased machinery for $100,000 and promised that the machinery would be returned to the lessor at the maturity of the lease. Okay, so I'm going to pull in this table here that is going to give us the all the different reasons under GAAP and IFRS that it would be recorded as a finance lease. So walking through these here, the lease transfers ownership of the underlying asset to the lessee. So in no instance does it mention transferring ownership, so that's not going to be any reason that we rule any of these out. The lessee has the option to purchase the underlying asset and is reasonably certain it will do so. None of these questions mention that either, so that's not going to be any reason to rule an answer out. Third bullet here, lease term is for a major part of the asset's useful life. So that certainly applies here to answer B. So we've got, we'll we're leasing the jet for 10 years and the economic life is 12. So that would certainly be for a major part of the asset's useful life. So that's probably going to be our answer here. But let's just read these last couple bullets just to make sure. Present value of the sum of the lease payments equals or exceeds substantially all of the fair value of the asset. We've got the present value here, and the fair value, which does not exceed. So we're going to rule out A. And then last bullet here, the underlying asset has no alternative use to the lessor. That one doesn't apply either, but I think for answer C, we can kind of use common sense because this sounds exactly what a lease is. You're leasing it for a set amount, and then you're returning it at the end, basically renting the machinery here. So this is going to be a finance lease. Due to this third bullet here, we're using it for a major part of the asset's useful life. So we're going to go with B. Question 60. When introducing herself to a potential client, Jean-Sue Halden usually says, I was awarded a CFA degree in 2015. Halden is most likely. So with these ethics questions, a lot of times there's going to be kind of two layers to what we're looking at. So first layer is we have three answers. One of them is not in violation, and then two are in violation. So first thing we can do when we read this is basically determine whether they're in violation or whether they're not in violation. If they were not in violation in this case, then we can just go ahead and take A and move along. So this is a good way to kind of save some time on the exam and simplify some things for yourself. So in this case, though, we're going to have to dive down to that second layer because the CFA is certainly not a degree, it's a charter. So it's going to be a violation. So we're going to cross off A. So now that second layer we'll dig into. So we're in violation. What standard then does this apply to? So either conduct as members and candidates in the CFA program, or C, reference to CFA Institute, the CFA designation, and the CFA program. Since this is something where she's introducing herself and talking about the CFA degree, this is going to be standard B, standard 7B, reference to CFA Institute and the designation. So we're going to go with answer C.